Welcome to the Clark Pacific Quarterly Investment Update. The investment conditions for the quarter ending June 30 were volatile and challenging. The Greek debt crisis and Chinese stock markets have weighed heavily on investor sentiment. This volatility is shown by the fall in the ASX 300 by 6.5% for the quarter ending June. The broader Australian economy picture is subdued. The Australian economy grew at 2.3% and inflation at 1.3%, the cash rate is at a record low 2% and unemployment is at 6%. The Australian dollar has fallen to finish the financial year trading at 74 cents US. The Clark Pacific portfolios have performed very well over the last year. Performance over the last quarter, however, has been flat, with the most conservative portfolio gaining nearly 1% and the most aggressive portfolio losing just less than 1%. Whilst it is always disappointing to suffer a loss in value, no matter how small, we are very pleased with these results considering that the Australian stock market was actually off by 6.5% for the quarter. Indicative annual returns for our model portfolios ranged from 7.5% for the most conservative to 12.7% for the balanced, 15.9% for the assertive and 18.7% for the aggressive portfolio. These returns remain well above our long-term expected averages. This compares to the median superannuation fund returning 9.8% for the year, according to Chant West. The very pleasing aspect of the portfolio's performance is that the investment portfolios have actually managed to defend and protect capital in a very volatile and challenging investment markets over the last 3 months. Our investment committee met last week. The role of the investment committee is to review performance, make tactical asset allocation recommendations, and to hire and fire investment managers. Following this meeting, our investment outlook remains relatively unchanged. We remain unenthusiastic with regard to the Australian stock market, as values look relatively high with a restrained growth forecast. We believe that international markets still present opportunities, from a recovery story in Europe and growth in emerging Asia and America. Listed property and infrastructure still look overvalued, as displayed by them trading at 20 to 30% over net tangible assets. The fixed interest and bond markets look increasingly risky, with negative yields in some European countries. That means people are paying banks to hold their money, which just seems crazy to us. We continue to favour alternate asset classes. Having interviewed all portfolio managers, the investment committee has decided to make no changes to the asset allocation and no changes to the current allocation given to existing investment managers. We believe our portfolios are well positioned moving forward. Please share this presentation with a friend or colleague that may benefit from our advice. Thanks for watching and have a great day.